Forecaster.co helping CEOs and CFOs do their financial planning. They're doing $120,000 a month today in revenue, up from $30,000 a month just a year ago. They've raised $5 million to date, targeting another $8 million round right now. Their last round valuation was a $10 million valuation at about 27x multiple. We'll see what happens now. They've gotten some good interest inbound already, serving 550 customers that pay on average $218 per month. Again, forecaster.co. Hey, folks, my guest today is Logan Burchett. He's from Nicholasville, Kentucky, and currently the founder and COO of a company called Forecaster.co. It's an online software that helps founders forecast revenue, predict runway, and understand their numbers and get funded. His co-founder and he came up with the idea back in 2018, and they've since grown to a wide user base, taking the company through prestigious Techstars Accelerator, raised $5 million venture capital, and then grew the team to over 25 folks. All right, Logan, you ready to take us to the top?
I am ready, Nathan. Happy to be here.
All right. Yeah, this is a hot space. I mean, you saw companies like Pry and Finmark raise VC, and that they exited, but it was pretty quick. And you sort of wonder, well, wait a second, can you actually build a big software company in this sort of forecasting space?
Yeah, it's a really great question, and it is pretty wild to see how hot this space is. I mean, if you go back, to the pre-Carta days, Carta got really, really big back around like 2018, and of course now it's a $7 billion company. So I think what happened was you saw a lot of these people that kind of mentally connected the dots that, hey, if this can be done in a cap table, if you can basically software a cap table, then a financial model kind of sits adjacent to that. So you're seeing a lot of people kind of coming out of the woodwork tackling the space. But to your point, it is quite a bit more complex than a cap table management software whenever you really get into it. And I think that what you're seeing is there are a lot of people that are tackling the space. Pry and Finmark both had really, really solid exits for where they were, in terms of revenue and customers. They were both relatively early, but they exited for a decent amount. We, of course, know that Pry exited for 90 million. We haven't yet found out publicly what Finmark exited for, but
and the Pry 90 million though, how is that split up between cash and stock?
That's a great question. And like, honestly, like we don't 100% know the answer to that. If I had to guess, I would say it was pretty heavy stock. But either way, I mean, I know that they weren't really generating a ton of revenue. But either way, I mean, I think that the space is really, really interesting just because it's been dominated by Excel. 98% of financial models are built in Excel. To your point, the challenge is maintaining the flexibility that Excel has, but also creating a standardized product that then you can integrate with and things like that. We've got about 550 customers right now doing about 1.4 million in revenue. And we're seeing.
You must listen to the show. You give me the numbers. I don't even have to ask. That's great.
Oh no. Well, I'll tell you everything. We're so transparent. Like, I mean, we share our financial model with people. That's just kind of the company that we are. So we don't mind sharing stats. We don't mind any of that. But
so if you're doing like 1.1 today or about $90,000 a month, where were you exactly 1 year ago? Do you remember?
So 1.4 today. We were doing about just shy of 30,000 a monthly recurring revenue about a year ago.
Okay,
so
very cool.
We're probably like high 20s now. We're at about 120 of monthly recurring revenue. Yeah,
yeah, that's great.
There's a lot of product to build in the space for sure, and moving upstream is definitely kind of like the direction that we're going and building out those broader feature sets for folks.
So those 550 customers say, what are they paying you per month on average?
Yeah, so we only do annual subscriptions, and it's an interesting question because historically it was a one size fits all. We're still technically in beta. If you go on our website, you'll see a beta tag. We're going to be moving that off. It's more of a marketing ploy at this point. But for the longest time, people just paid us a standard $2,000 a year, and then we would give them a white glove onboarding because they got us paid back. Like we got paid on the front end. We could afford to put some analyst hours behind the account, get them set up, get them trained, all of that. Here in November, we really started rolling out our variable pricing model, which similar to Pry, this is inspired by Pry. We're going to be pricing our annual contracts based off of the monthly expenses of the customer. So the idea there being that larger customers we can afford to spend more time with, we can get them set up, we can train them, make sure that they get more success out of the platform as much as we can get. And then we'll charge them more for that. So to directly answer your question, of the 550, if you just do a straight up blended average today, then it's about $1,400 if you like discount it per year, because we do some discounting for partners and things like that. That's slowly creeping up since November, since we started releasing this.
Wait, what do you mean by that? If I take $120,000 a month or 1.4 million AR divided by 550, it's about $2,500 per customer per year on average.
Yeah. Okay. So it's I guess prior to November, it was kind of like roughly about that like 1,500, 14, 1,500.
Oh, I see.
So like our highest paid customer right now pays us about $15,000 per year. But prior to that, they were paid, the highest paid customer paid us $2,000 per year. It was just because we hadn't really focused on our pricing model up until that point.
Oh, what's going on there, YouTube? Good to see you guys. Now imagine this. You love watching these interviews with SaaS founders, but imagine if we took all of the valuation data out from over 2,807 interviews I've done manually. Saves you a lot of time. Well, we've done this. We've built it into the beautiful interface inside of FounderPath. Check this out. I'll show you how you can access this in a second, but you log in, you connect your Stripe account, you see your valuation real time, you can see what it changed over the past 88 days, and even set goals for valuation this year. Now, the secret to valuation is there's many different ways to value a SaaS business. So the reason you're going to see 3 or 4 different valuations inside of your FounderPath dashboard, this is all free by the way, is because depending on who's doing the buying of your SaaS company, you're going to get a different valuation. A VC is going to pay a different valuation. Private equity firm is different. If you're going to do a minority sale, that's different. And if you sell the whole business, that's a different valuation. You can see all those when I hover over here. Right, so the teal is what a VC would pay, yellow is what private equity, and red is if you sold the whole thing outright. Now, what's cool about this is not built off random data. Again, you guys hear these interviews on YouTube. All these data are built from real-time valuation data points founders share with us on the show. So traction, 1.2 million, seed round, 3.7 raise, they sold 22% of their business. Go in here and filter by the event. Maybe you only want to see companies that have sold the whole business. Well, here are a bunch that have been acquired, the valuation and the multiple. Maybe you're going out right now and you're raising your seed round. Well, go in here and look at all this recent seed deals that went down, what they raised, what valuation they raised at, and what percent that they sold. There's never been a larger data set of SaaS valuations than what you can get now inside of FounderPath, and we're thrilled to bring it to you. All right, we're going to go back to the YouTube video here in a second, but if you want to check this tool out, if you want to jump in and sign up, you can check it out for free to get your valuation at this link, founderpath.com/products/valuations. Or if you go to founderpath.com and hover over products, click on get your valuation here, and go ahead and sign up to give it a whirl. Again, all that valuation data live right inside the platform. I hope to see you there. All right, let's jump back into the interview. So obviously don't name the customer, but someone paying you $15,000 per year, how much total expenses do they probably have?
Yeah, so it's usually, so if you're at that $15,000 tier, then you've got over $500,000 a monthly expenses.
Okay, interesting. So it's sort of like, what is that, like 10? It's like 15, 20% or something like that, 20%, or no, what is that? 2% of monthly expenses.
Yeah, something like that. One of the main reasons that we wanted to kind of like price along the expense curve is that we never wanted to be like an overly significant portion of your overall expenses. It was kind of our idea. So exactly. Yep.
Yeah. So you're paying, sorry, no, it's actually, it's 3%. So like if you're paying 15 grand a year and you're doing 500K a month in expenses, that's almost 3%. That's super cheap, right?
Yep, very cheap. Yeah.
I always like it when someone takes something from that they saw a competitor doing that they liked and they're implementing it themselves. A lot of people, their egos are too big to copy, but I think that's ridiculous. So how did you know that it was working for Pry? How did you know it was a good idea to copy?
Yeah. So what's funny is we didn't, right? We saw that they were doing that. Obviously we saw that they had some success in their exit, depending on kind of like what it ended up looking like. But what we did was we really liked the idea of an expense-based pricing for obvious reasons. It's kind of a good way to price along the demand curve. So once we decided that this was something that we wanted to look into, we just went back and just started doing like plain customer discovery. We went back to our old customers, our beta customers, and we said, hey, listen, if we were to price in this way, and if we were to kind of reassess your price every single year, and we did it with this fashion, how would that make you feel? What would you think? Would that turn you off? Would you be okay with that? Assuming that we're adding more value as you're getting bigger as well. We're not just charging you charging you more for the literally same thing. And they all were like, yeah, I mean, I think that's totally reasonable. It seems like a fair way to price. Never going to be too big of an expense if you do it this way. And that's whenever we went forward with it. Was after.
How do you do that though? Like, let's say I'm with Forecaster and you and I are negotiating my new plan for the next 12 months. Are you looking at my monthly expenses from last month being 500K? Or are you saying, Nathan, what do you think your expenses are going to be 12 months from now?
Yeah, we do it retroactively. So we look at your like really like the average of the last 3 months worth of expenses in order to try to like deal with seasonality if you have like a big expense month or something like that. I'd be lying to you if I said that we had that completely nailed down because we just rolled this out in November, so that hasn't happened yet. So like in theory, that's how it would work, and we hope that it works, without a hitch. But that's the idea anyway. We have prepped everybody for that conversation on the front end though.
Yeah. Walk me through. You've mentioned put analysts on the account a couple times. What does your team look like today? Let's just start off with how many are only writing code on engineers?
Yeah, so it's pretty even, right? So we have 33 employees right now. So you could pretty much split it evenly between growth, financial analysts, and development. Like that's really kind of like it's almost like a third, a third, a third. And so what you just zoned in on is what we call our white glove onboarding. So it's I think one of the key differentiators for us in the space. Like I was a fractional CFO for a number of years, as was my co-founder Steven. And we just knew that if you plop somebody in kind of like a deeper like financial analysis software, they're going to fall flat on their face. It's kind of like a specialized business function. So having a seed stage founder jump in and just say, here's the keys, go ahead, have fun, that wasn't going to work out too well. So what we do instead was we only do annual contracts. We pair them up with a financial analyst, a finance expert, specifically for venture finance. Their job is to help them build the model, use the data that they have, help inform the forecast, train them on how to use the forecast, and then we check in with them sporadically, right? And that's kind of like, it's almost like I don't like to use this word, but it's kind of like a blend of like SaaS and services in a way. Now, the idea is most of the services component is done on the front end with an onboarding, and then you kind of fade off kind of once the customer's been trained up. But
and so who are like, where do you find these analysts? For example, I mean, Stripe and some other, even SPV, sometimes like their folks, and they're doing new deals with SaaS companies. They actually have like a massive team in India that does a bunch of like the literally cleaning the P&L, the balance sheet, et cetera. Who are some of these folks that you put in your financial analyst category?
Yeah, no, it's a great question. So everybody here that's an analyst is based in the US, except for one of our analysts whose name is Phoebe, who is based over in the UK. A lot of them are previous founders, right? We just hired, we have, I think, 3 analysts that were founders before they joined Forecaster as financial analysts. And they were like kind of financy founders. We have some folks that were like accountants beforehand, but like all of these people are kind of more financial inclined mathy people that are really, really interested in startups. And so they wanted to kind of jump on board on us while we're kind of like near the ground floor.
So what is he like? Sandeep, he's based in Austin. You just hired him. This was like a month ago. It says he's starting. It looks like you found him through LinkedIn, and he's got a lot of experience at the New Chip Accelerator before this. But like, what does his day-to-day at Forecaster look like?
Yeah, so this is his second day. So right now his day-to-day is just getting onboarded. But in his day-to-day, the way that we kind of think about it is it's going to be basically split almost 50-50 of going into Forecaster and helping our clients like actually build out their financial models in Forecaster and getting on calls with them just kind of.
What does that mean though? Is he saying like, hey, here's how to connect to your QuickBooks so we can start manipulating your data? Or is it like upload this CSV folder to populate your charts?
Yeah, it's more just like straight up bottoms up financial modeling. So it'd be like, hey, let's go in, let's connect your QuickBooks account. We'll show you how to do that. But then, I see you have these revenue categories in QuickBooks. Let's go to the revenue stream section of Forecaster, build this out, make sure it has all of your important metrics in there, make sure that we can craft a story that makes sense to investors, lenders, what have you.
So is he the one where if in QuickBooks, the company has labeled a bunch of these weird things and you're like, no, in Forecaster, this is actually COGS and this should be
correct.
Team. He's helping like sync the two.
100%. Yeah. So it's basically just like, at the end of the day, we want to build a forecast that our customers can understand and use and is actually valuable. So that's why we go through, and a lot of times we'll get people that say, hey, my QuickBooks is a mess, like my accounting, like I don't really know. That's okay. Sandeep would be the type of person that would go in, say, well, let's set up your forecast where it makes sense. We'll map it back to your QuickBooks, but this can be your source of truth now. And then inform them on how to use it, plan for cash, fundraising, all of that stuff.
Really interesting. Speaking of fundraising, so have you guys bootstrapped or, well, we know you raised because you said it in the bio, but walk us through the rounds. When was the seed, but pre-seed?
Oh, so we're deep in the throes of it right now, Nathan. So we're in the middle of a Series A at the moment. So we've raised in total about $5 million, kind of as you alluded to in the bio. We're in the process of raising 8 million more. So we actually just kicked this off on the 17th. My co-founder, Steven, is actually out in San Francisco right now, and he's just kind of back-to-back meetings. But we raised a pre-seed round on a convertible note. Then we raised the seed round, which was led by Resolute Ventures out of San Francisco. And now we're in the middle of our Series A round, $8 million Series A round.
When was the seed round? What year?
That was February of 2021 was whenever we actually got the cash closed. And we kicked it off basically Jan 1 of that year.
Okay, so pre-seed there. And how much did you raise there?
In the pre-seed we oversubscribed to $600,000 round up to 750. At the seed round, we raised 2.5 million. And then in between there, we had some little bridge rounds that when you add it all up, it's around $5 million.
And that pre-seed round of 600K, that was, you said, at a 7.5 million cap?
No, that was on a convertible note. And there were two caps because one of them was a Techstars cap. And then the other one was just the Louisville, Kentucky, teeny tiny, small town investor cap of I think it was 2.5. It might've been $3 million or something like that.
Okay. Fair enough. And then the seed, most people are selling 10 to 15% of the company in the seed round. Are you sort of in that same range?
We did. It was at a $10 million post. So it was around 10%. Yep.
Yeah, that's not bad at all. And then what are you targeting with the 8 million? What would you like to see in terms of post-money valuation?
I hesitate to honestly say this just because we're big proponents of just letting the market determine a valuation. But what I will say, which I think is a pretty safe answer, is we're raising $8 million. So if you're trying to sell roughly, if you're trying to keep it in that 20%, that'd be a $40 million post. So 32.3. That's kind of what we're hoping for. But we'll see. We'll see what the market says.
What is the market? I mean, everyone's saying right now you can't raise money, right? What are you hearing? I mean, do you have a term sheet yet?
No, we don't have a term sheet, but we're on our first round of second meetings. There's definitely interest. You can definitely raise money right now. And this is kind of what we've seen. Obviously, we talked to a lot of VCs gearing up for the Series A. Basically, what we've heard is that, yes, capital is still being deployed. Yes, you can still get a round done. What you're probably going to see is valuations kind of squeezing. It's not going to be 2019, where you have companies with no revenue that are raising, at a
40 posts though would still put you at a 28, 29x multiple at your current 1.4. That's still pretty healthy.
Oh, big time. Oh, yeah. Don't get me wrong. I mean, I'd be very happy with that valuation if we can get it. I think in 2019 you might have seen an even higher valuation just because the markets were going a little bananas. But yeah. I mean, you can still get a round done is what we've been told.
And so when you email all these VCs in a recessionary period, what's the subject line you use to get them to open and return it? Do you say net dollar retention 150, raising now, must open?
Yeah, it's a great question, and I would say that luckily we don't really do a whole lot of cold email outreach to investors. We have a really great network through Techstars. We have a really great network through Resolute. I mean, they're absolutely incredible, and we're big proponents of the idea that cold emails while fundraising, it's just really, really hard. It's really, really tough to get an investor to open up a cold email and then take a meeting with you. If you can get warm intros, it's so much easier, but it's all in the prep work, right? If you need to get a giant list of investors, this is your target list, and you got to do the work to be okay, I know this person that knows this person that knows this person. Give me affordable email intro. And then that's how you get a lot of meetings. And we've got, I think, 45 meetings set over whenever we started, a few days ago till the next couple of weeks. And like I said, we're running a tight process here. So we're already getting some, follow-up meetings, but
that's awesome, man. What does your burn profile look like today? Obviously you always want to, the best alternative to raising, the stronger you are, the better round you can probably actually raise. So when you look at what you're burning today per month, what do you guys, on the order of magnitude of what?
Yeah, it's just over about $200,000 that we're burning per month. So about 220, 230, depending on the month. And then obviously once we get the 8 million in, we'll probably ramp that up for a little bit more sales and marketing. And
just to be clear, your net burn monthly right now is about 200 grand.
Correct. Yeah.
Okay. And so what does that leave you in terms of runway, right? Cash in the bank? It has 10 months of runway, 18 months of runway, more?
Well, right now we're actually at about 13 months worth of runway, assuming that we don't raise any more money. And that's mainly because our current investors have already committed to the Series A and they've already funded a portion of that. So
nice. Yeah. So you sort of had an initial close already because the 2.5 million folks, they put in more.
Correct. Yeah. And pretty much everybody that's invested in the company, we sent them an email and said, we want to give you guys first crack at it. And then we got about 500.
Wait, where was it? Actually, sorry, I have 2.5 seed, 600 pre-seed, but you said you've raised 5 million today. Where's the other 2 million?
We've had a few kind of bridge rounds in between then. So we had an extra 200,000 between the series, the pre-seed and the seed. And then we did another, I think 1.1.
I see.
So we had some bridge rounds in between. Yeah.
I see. Very cool. I guess last question before we wrap up. It's very hard to get CFOs to stop using Google Sheets and Excel. Why do they log into Forecaster every month?
Yeah. So it's integrations, analytics, and reporting are really the big three. So I think that the reason that it's really hard to get CFOs to quit using Google Sheets and Excel isn't inherently because they just love writing Excel formulas so much. It's just because that's what they're used to, and Excel has just been the default for so long. But I think that the opportunity really that we have, and this is why we're seeing so much success in the space, is that we can match Excel's flexibility, but we can do so in a way that we can still integrate with all of your data. So you're not having to go in and literally update it every month. That's how you get them interested, is you say, look, I can give you the same amount of value with less amount of time, and then I can make it a lot more collaborative with a better user experience and all of that. So,
and are you usually those 550 customers, is it usually the CFO paying on their card, or is it the CEO paying on their company card?
Usually the CEO paying on their company card. Almost.
Oh, interesting. So are you selling to, you would say then you're selling to CEOs and then relying on the CEO to get the CFO to use it?
Our average user is like a seed stage founder. Yeah, that's exactly right. But then we obviously have companies larger than that, Series A, Series B. So then it kind of like the keys are kind of handed over to the CFO at that point.
I see. Yeah. Well, Logan, we're certainly rooting for you. It's a heck of a story. Let's wrap up here with the famous five. Number one, what's your favorite book?
My favorite. All right. So I'm not sucking up here, but I think it might be your book, How to Be a Capitalist Without Any Capital.
Oh no, you read it.
I read it. So I actually bought a Chrome extension because of it. It's called flowtime.biz. Yeah. I bought it.
Nice.
In your book. Yeah.
That was one of my favorite first business deals I ever did. I had no idea what I was doing, but it worked out nicely. Flowtime website blocker. Very cool. Yep. All right. Thanks for the compliment. Number two, is there a CEO you're following or studying?
CEO Brian Halligan. I really like Brian Halligan. Yeah, I think he's really, really interesting. I like it because he had a very high churn rate at HubSpot, and he was able to like chop that down to basically nothing, which is really interesting.
Yep. Number three, what's your favorite online tool for building Forecaster besides your own?
Favorite online tools, Notion. I think it's really very flexible, and I use it for a lot of stuff.
Number four, how many hours of sleep do you get every night?
Oh, I'm asleep. I'm crazy about sleep. I get 8 hours a night. I make sure I get 8 hours a night. I have to.
I'm the same way. What's your situation? Married, single, kids?
I am married. Got married in pandemic 2020. So
congrats. Any kids yet or no?
Nope, not yet.
Not yet. All right. And how old are you, Logan?
I am 31 years old.
Last question. Something you wish you knew when you were 20.
Something that you don't have to take a standard career path. You don't have to go work for the man. You can build your own thing. Whenever I kind of like came to that conclusion, I immediately left and started Forecaster, and I don't think I'm ever going back to a standard 9 to 5. So
guys, Forecaster.co helping CEOs and CFOs do their financial planning. They're doing $120,000 a month today in revenue, up from $30,000 a month just a year ago. They've raised $5 million to date, targeting another $8 million round right now. Their last round valuation was a $10 million valuation at about 27x multiple. We'll see what happens now. They've gotten some good interest inbound already, serving 550 customers that pay on average $218 per month. Again, forecaster.co. Go check it out. Logan, thanks for taking us to the top.
Thanks so much, Nathan.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company, or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them, and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.